In this video, I will be providing an introduction to consolidated financial statements. When accounting for stock acquisitions, it's all about control. The acquirer, or parent company, holds a controlling interest in the target company. The target company, or subsidiary, is controlled by the parent, but also has other minority shareholders referred to as the non-controlling interest. Control is defined as the power to direct management and their policies. Control can be obtained through ownership of voting shares, contract, or otherwise. The usual condition for a controlling financial interest is ownership of a majority voting interest. Remember from the investments chapter, this was typically considered to be greater than 50% of the shares outstanding. Also remember that I said there were ways in which an entity could exert influence disproportionate to the number of shares owned, and that we would talk about it later. Well, it's finally later. Control can also be gained through what is called a variable interest. In this case, control exists for a reason other than the ownership of voting shares. This is one of the things Enron did that caused so much trouble. They took large amounts of their liabilities and spun them off into variable interest entities. Under the accounting rules at the time, because Enron did not make themselves the majority shareholder of these companies, they did not have to be consolidated, and thus the liabilities were removed from the financial statements. However, the contracts creating these entities specified things like if the entity needed a cash infusion to be able to continue its operations, Enron would provide that cash. These clauses gave Enron effective control of the spun-off entities. The purpose of consolidation is to present the operating results and financial position of the parent company and all of its subsidiaries as if they are one entity. Recall that we will add 100% of the parent company with 100% of the subsidiary and reflect the portion of the subsidiary that is not owned by the parent in non-controlling interest. Let's say Phillips owns a controlling interest in Sanchez and a controlling interest in Thomas. We will need to prepare one set of financial statements that includes the operations of all three. We will then use the non-controlling interest to represent the interest in Sanchez and Thomas of shareholders who are other than Phillips. When the parent company purchases their investment, they will record the asset at cost. In this chapter, the account will typically be called investment in S, but in the investments chapter, we referred to this account as equity investment. In this case, Phillips purchased shares of both Sanchez and Thomas and so has an asset account for each. However, at each reporting date, we will need to take Phillips's balance sheet and combine it with the balance sheets of Sanchez and Thomas. Consolidation is the process by which we take the financial statements produced from each entity's accounting records and turn them into one set of financial statements representing the group of companies as a whole. Okay, so anyone notice anything interesting about our consolidated financial statements? Obviously, most of our accounts, like cash and accounts receivable, have increased because they now contain the operation of 3 companies. But anything surprising jump out? Great question, Chloe. Investment in Sanchez and Thomas were just summary items. They essentially represent the Phillips share of the net assets of those companies. But when we consolidate, we add all of the assets and all of the liabilities from those companies to Phillips's balance sheet. So keeping the investment account would basically be double counting. Excellent observation, Annabelle. The equity accounts of Phillips actually didn't change during the consolidation, other than to create this new non-controlling interest account. The principles of consolidation are the same as an asset acquisition. We will write up the assets and liabilities of the subsidiary as of the date of acquisition and add them to the balance sheet of the parent company. However, in an asset acquisition, because the acquirer purchased 100% of the assets and the liabilities of the target company, we did not need to add a non-controlling interest account. Notice, too, that I was careful to say that we would add the assets and liabilities to the parent's balance sheet rather than the general ledger. All of this will happen topside or outside of our general ledger system. We'll talk more about that in the next lecture video. This concludes our introduction to consolidations. Don't forget to email your questions for our discussion.